Imagine a world where the hottest technology commodity, the thing driving literal lines around the block at a big box retailer, isn't a revolutionary new smartphone or like a next generation laptop.
Right.
It's a pack of trading cards.
Yeah, literally just cardboard.
Exactly. And at the exact same time, this same retailer is quietly leveraging its massive fiscal footprint to mask this high-margin advertising network that is essentially levying a tax on the entire consumer tech industry.
It's wild. It really is.
If you are joining us for this special Talk Tickers deep dive, you know we are here to bypass all the corporate fluff and dig straight into the structural mechanics of the market.
Get right to the numbers.
Right. Today, we are tearing into the Q1 fiscal 2027 earnings call for Best Buy, ticker symbol BBY.
A classic.
Yeah, a 27-year retail veteran. And our mission today, we've got the data, we've got the underlying unit economics, the strategic shifts. We were going to determine exactly how they are fundamentally altering the DNA of this company.
And we're going to try to do it fast, too.
Right. Actionable, data forward, and under 5 minutes.
Yeah.
Okay, let's unpack this.
It is such a critical time to be analyzing the specific business model.
Yeah.
Because parsing through a modern corporate earnings transcript, especially in retail, requires, looking past the safe harbor statements.
Mm-hmm.
You have to find the actual levers being pulled on the factory floor.
Because the narrative they project is, well, it's usually pretty sanitized.
Exactly. Best Buy is projecting this outward narrative of stability, but the mechanics operating under the hood reveal this profound, really aggressive transformation.
Yep.
They are actively shifting from a traditional linear retailer into a diversified technology and media platform.
Which is crazy to think about.
Yeah.
But I found the headline numbers for this quarter highly counterintuitive.
Oh, absolutely.
So let's start by establishing our baseline reality on the top and bottom lines. Best Buy reported Q1 revenue of $8.9 billion.
Right.
That is an increase of 1.9% versus last year.
Which, on the surface, nearly 2% growth on an $8.9 billion base. That signals that the post-pandemic consumer technology hangover is finally stabilizing.
Yeah, the hangover is fading.
Exactly. That stabilization is the foundation for literally everything else they are executing right now. But the metric that truly dictates the pulse of a brick-and-mortar operation is comparable sales.
Right, the comps.
Comps. Best Buy reported that their comps grew 2%, which decisively beat their own internal guidance of 1%.
Let's test the weight of that 2% figure for a second.
Sure.
Because in a traditional growth tech stock, a 2% top-line expansion would trigger a massive sell-off.
Oh, Wall Street would panic?
Right. But for a legacy retailer navigating a really complex macroeconomic environment, this is functionally a massive victory.
It really is.
And it becomes even bigger when you look at how that minor top-line movement affected the bottom line.
The earnings per share.
Yes. Adjusted diluted earnings per share, EPS, came in at $1.28. That is a year-over-year increase of 11%.
Huge jump.
And their adjusted operating income rate expanded by 30 basis points to 4.1%, and domestic gross profit bumped up 20 basis points to 23.7%.
And this is exactly where we need to separate the underlying business health from, financial engineering.
What do you mean?
Well, those margin expansions, 30 basis points here, 20 there, they might sound microscopic to a layperson.
Yeah, fractions of a percent.
Right. But on a revenue base approaching $9 billion, we are talking about hundreds of millions of dollars in highly efficient profitability.
Okay, but wait. This EPS jump of 11% on a revenue bump of just under 2%, it requires some scrutiny.
I agree.
It feels asymmetric. It's like getting a 2% raise at work, but somehow having 11% more money in your bank account at the end of the month.
That's a great analogy.
How did they pull that off? If a company's top line is barely moving, but their earnings are skyrocketing, they're usually cutting something to the bone.
Right. You assume layoffs or closed stores.
Yeah. Are they sacrificing long-term growth investments like store maintenance or floor staff?
Yeah.
Just for a short-term EPS pop?
It's the right question to ask for sure. But the mechanism at play here isn't necessarily destructive cost cutting. It is a textbook execution of SG&A leverage.
Break that down for me.
So when we talk about selling general and administrative expenses in a physical retail environment, we are talking about a massive block of fixed overhead.
Rent, lights, that sort of thing.
Exactly. It costs Best Buy virtually the exact same amount of money in rent, electricity, and baseline payroll to operate a 40,000 square foot store on a Tuesday, whether 500 people walk through the doors or 5,000 people walk through.
Right. The break-even threshold is a fixed target every single month.
Exactly. And once they cross that break-even threshold, the unit economics of every incremental sale change dramatically.
Because the rent is already paid.
Because the rent is paid. Since their baseline operating costs are relatively static, when they beat their comparable sales target and generate an unexpected 2% increase in revenue, a disproportionately massive percentage of those new dollars flow completely unimpeded to the bottom line.
Wow.
They essentially captured additional market demand without having to scale their operating costs to meet it.
Okay, so it's not financial engineering at all. It's just pure operational efficiency.
Exactly.
And you can actually trace that momentum visually if you map out the monthly cadence of the quarter.
Oh, the month-by-month breakdown is fascinating.
Yeah, their enterprise comparable sales were actually negative 1% in February.
Rough start.
Right. But then they crossed into positive territory at 3% in March and accelerated to a 4% growth rate in April.
And that monthly acceleration curve is vital because it proves the growth wasn't a one-off anomaly.
Right. Like it wasn't just a single promotional weekend skewing the data.
Exactly. It was sustained momentum. But to understand the true durability of this growth, we really have to isolate the specific consumer behaviors driving it.
Because Best Buy isn't just one monolith.
No, it's a composite of highly distinct micro-businesses, and their performance is radically divergent right now.
So let's unpack the core growth drivers first. The story behind the numbers. Gaming was an undeniable heavyweight this quarter.
Huge.
The transcript specifically cited aggressive hardware momentum from the new Switch 2, the PS5, and Xbox. But, hardware margins are notoriously thin.
Oh, razor thin.
Right. The real magic of a console boom isn't the margin on the box itself. It's the ecosystem lock-in.
Precisely. A console is essentially a Trojan horse for attach rates.
Trojan horse, I like that.
Think about it. When that Switch 2 goes into the shopping cart, the consumer psychology shifts from a primary purchase to accessory accumulation.
You need all this stuff to go with it.
They need the Pro Controller, they need the specialized memory expansion card, the screen protector, and most importantly, the software.
Yeah.
The console might yield a low single-digit margin, but that $60 HDMI cable or $80 carrying case, those carry margins well north of 50%.
Which perfectly explains why management was so keen to highlight the massive software attach rate from titles like Pokemon Pokopia.
Oh, absolutely. Software drops drive pure foot traffic.
Yeah, and that foot traffic converts into those high-margin accessory sales. But what really anchors this quarter's success is computing.
Yes.
They just posted their 9th consecutive quarter of positive comparable sales in the computing category. 9 quarters.
That's practically unheard of.
Right. Because so many analysts assume that the massive pull forward of laptop purchases during the 2020 and 2021 lockdowns would create this multi-year dead zone for PC sales.
Yeah, everyone thought people wouldn't need a new laptop for 5 years.
Exactly.
And the assumption was logical, but it underestimated 2 critical market dynamics. First, the natural replacement cycle of consumer electronics is ruthless.
They just don't last.
They don't. Those entry-level laptops purchased for remote schooling 4 years ago are now struggling to run modern operating systems efficiently.
Yeah, the battery degradation alone forces a hardware refresh.
Exactly. But the second, much more structural dynamic driving this 9-quarter streak is their enterprise arm, Best Buy Business.
This is so fascinating. The B2B performance is arguably the most overlooked metric in this entire report.
Nobody talks about it.
Nobody. Best Buy Business grew an astonishing 15% overall this quarter.
15% is massive.
Because we are conditioned to view Best Buy strictly through the lens of a direct-to-consumer retailer, right? Like a place where you go to replace a broken television.
Exactly, the consumer mindset.
But they have quietly built a formidable IT procurement division, servicing education, corporate enterprise, and healthcare clients.
And the unit economics of enterprise procurement completely alter the risk profile of the computing category.
How so?
Well, a hospital network upgrading its administrative terminals does not buy one laptop. They order 3,000 identical units, complete with multi-year Geek Squad enterprise service contracts and bulk software licensing.
And those enterprise contracts are incredibly sticky.
Very sticky.
They provide a predictable, recurring revenue baseline that smooths out the severe volatility of the consumer holiday shopping curves.
Exactly.
But while computing and gaming are the massive foundational pillars, the transcript revealed a subsect of growth that frankly challenges our traditional definition of this company.
Oh, the emerging categories.
Yes. Management highlighted a basket of emerging categories where sales literally doubled year over year.
Doubled.
And the composition of that basket is fascinating from a consumer psychology standpoint. You have bleeding-edge hardware like AI glasses and 3D printers sitting right alongside health rings, PC gaming handhelds, and trading cards.
The trading cards are the ultimate anomaly here.
They really are. I read the analyst Q&A session at the end of the earnings call, and one of the institutional analysts explicitly questioned the trading card strategy.
Like, why are we selling Pokemon cards?
Basically. And management confirmed that coordinated card drops are manufacturing lines of people outside physical locations before they even open.
It is a brilliant exploitation of physical scarcity.
Right.
Think about it. In a retail landscape desperate to compete with the infinite shelf space of e-commerce, Best Buy is utilizing the tactile, highly coveted nature of physical collectibles to force consumers into the building.
It's the gamification of foot traffic.
Yes.
Because if you are an online-only retailer, you pay Google or Meta a premium cost per click to acquire a single customer visit.
Which is getting more and more expensive.
Exactly.
Yeah.
But Best Buy is acquiring that same customer visit by simply holding inventory of a scarce physical asset.
And once that collector is inside the store, the cross-merchandising begins. The goal is to maximize the lifetime value of that foot traffic by exposing them to the AI glasses or the new computing lineup on their way to the register.
Oh, it's an incredibly cheap customer acquisition strategy. But, we can't look at this report with rose-colored glasses. While they are manufacturing foot traffic with collectibles, they are fighting a massive macroeconomic headwind in their major appliance category.
Yeah, appliances are struggling.
They've been a systemic drag on Best Buy's balance sheet for multiple quarters, heavily anchored by a completely frozen housing market.
It's tough out there.
The fundamental reality is that major appliance upgrades are highly correlated with existing home sales. If mortgage rates remain elevated and housing turnover stays paralyzed, the appliance market effectively flatlines.
The macro environment for appliances is toxic, which is why Best Buy's strategic response here is so eliminating.
What are they doing?
Well, instead of passively accepting the macro drag, they pivoted their entire appliance strategy to target what we call duress buyers.
Duress buyers.
Yeah. If housing turnover is dead, the only people buying refrigerators are the ones whose refrigerators catastrophically failed overnight.
Oh, right. And a duress buyer doesn't care about a minor price discrepancy. They care exclusively about speed.
Like, if my refrigerator dies on a Tuesday, I am not waiting 5 business days for a purely online retailer to coordinate third-party freight.
No way. All your food is going bad.
I am buying from whoever can place a functioning unit in my kitchen by Wednesday morning.
Precisely. And Best Buy recognized that their physical footprint and localized supply chain are formidable weapons against pure-play e-commerce giants.
Right.
They heavily invested in aggressive promotional pricing, localized marketing, and crucially, hyper-accelerated delivery logistics. Speed. By weaponizing their delivery speed, they successfully forced the appliance category out of negative territory and actually posted positive comparable growth in May.
That's incredible. They turned a logistics network into a competitive moat.
Yep.
And that reliance on physical scale is equally vital in their home theater division.
Oh, the TV space.
Yeah. On the surface, television revenue was flat. But the transcript shows they actually captured significant unit share growth throughout the quarter.
Meaning they sold more TVs, just at lower prices. Exactly. They are physically moving more individual panels and stealing market share from competitors, even if dropping prices suppress total revenue.
And that market share grab in televisions right now is highly calculated groundwork. They are positioning themselves for what is arguably the most significant consumer electronics catalyst of the decade.
You're talking about the RGB TVs.
The mid-June launch of the new RGB TV display technology. It is not an incremental update. It is a structural reset of the hardware market.
The rhetoric from management on this launch was unusually aggressive.
Yeah.
Like the CEO directly compared the arrival of RGB panels to the initial launch of OLED technology back in 2013.
Which was huge.
We're talking about a generational leap in display mechanics, and the timing is perfect.
Why is that?
Well, if you look back at the pandemic lockdowns of 2020, The industry absorbed a historic demand shock, selling roughly 49 million televisions.
Everyone was stuck at home.
Right. And the average replacement cycle for a primary household television hovers between 5 and 7 years.
So we are right in the window.
We are entering the exact epicenter of that replacement cycle, just as a revolutionary technology forces an upgrade.
And the underlying economics of the television market mandate these technological leaps.
What do you mean?
Over a 5-year cycle, the average selling price, or ASP, of a television naturally degrades as manufacturing efficiencies improve and components get cheaper.
Right. A 65-inch TV used to be thousands of dollars. Now it's a few hundred.
Exactly. To prevent revenue from collapsing, the industry requires a major technological shift to reset the ASP back to a premium level. RGB is that reset.
And Best Buy has engineered an absolute monopoly on that reset.
Which is brilliant.
For the first 12 months of the RGB rollout, Best Buy will operate as the exclusive national retail partner. You literally cannot experience or purchase this technology anywhere else.
And experience is the operative word here.
Yeah. Management is launching a massive marketing campaign titled Believing is Seen. Because RGB technology supposedly delivers unprecedented lifelike color accuracy and contrast, you literally cannot demonstrate its value through a YouTube pre-roll ad viewed on a 5-inch smartphone screen.
It doesn't translate.
The consumer physically has to stand in front of the panel.
And this completely validates the enduring necessity of the physical showroom.
Right.
If a hardware manufacturer wants to justify a $3,000 price tag on a revolutionary display, they need a controlled, high-fidelity environment to demonstrate the delta in quality.
Yeah.
Best Buy is the only entity with the national real estate to provide that showcase at scale.
But here's where it gets really interesting. This is where the narrative shifts from being a traditional hardware merchant into something much more sophisticated and, frankly, much more lucrative.
The margin secret weapon.
Yes. We have to examine the margin secret weapon hidden in this earnings call. The true economic engine driving that gross profit expansion isn't just selling more HDMI cables.
No, not more.
It's their U.S. marketplace and Best Buy ads. The domestic marketplace gross merchandise value, GMV, hit approximately $250 million in Q1 alone.
What's fascinating here is to really understand the power of this, we need to break down the mechanics of a retail media network, or an RMN.
Okay, let's do it.
So Best Buy Ads allows consumer electronics brands to purchase highly targeted advertiser space directly on bestbuy.com and within the physical stores.
Like sponsored products on Amazon.
Very similar. But what makes this ad inventory so incredibly valuable, far more valuable than a standard digital ad, is the underlying data.
First-party purchase data.
Exactly. With major tech platforms deprecating third-party cookies, traditional digital advertising is losing its precision.
Right, Meta and Google are struggling with tracking.
Yes. But Best Buy owns a closed-loop ecosystem of verified first-party purchase behavior.
Wow.
If Samsung wants to target consumers who bought a PlayStation 5 exactly 3 years ago and might now be in the market for a premium gaming monitor, Best Buy has the exact deterministic data to facilitate that ad placement at the exact moment the consumer is holding their credit card.
It fundamentally changes the margin profile of the company.
Completely.
Like a traditional retail transaction involves purchasing inventory at wholesale, bearing the risk of holding it, and hoping to sell it at a 20% margin.
Right. Heavy capital investment.
But in the Best Buy ads model, the margin on that advertising revenue approaches 70 or 80% because the infrastructure is entirely digital.
It's basically pure profit.
Combine that with the U.S. marketplace, where Best Buy allows vetted third-party sellers to list products on bestbuy.com, while Best Buy simply takes a commission without ever touching the inventory, and you have a massive capital-light cash machine operating underneath the traditional retail facade.
And if you strip out the physical hardware sales and isolate just the GMV of that marketplace, their domestic sales growth for the quarter would have tracked closer to 4%.
Wow. Double the reported growth.
Exactly. This high margin revenue is acting as a massive shock absorber, allowing them to aggressively discount front-end hardware like appliances to win market share, knowing the back-end ad revenue will preserve their overall profitability.
That structural advantage leads directly into what I consider the boldest maneuver in this entire earnings report.
The inventory move.
Yeah. When you look at their balance sheet, Best Buy's inventory ended the quarter up nearly 8% year over year.
8% is a lot.
Now, tech inventory is usually like a melting ice cube. Every single day, a processor or a memory chip sits idle on a shelf. Moore's law makes it slightly more obsolete and slightly less valuable.
Very true.
Holding an 8% surplus of rapidly depreciating tech assets seems reckless. I initially flagged this as a massive liability.
In a normalized macroeconomic environment, it would be a huge liability. But what Best Buy is executing here is a highly complex, proactive supply chain hedge.
Okay, unpack that.
They are essentially operating a commodities trading desk to outmaneuver the global semiconductor market.
Let's break that mechanism down because the implications are massive for their Q3 and Q4 margins.
Right. So the global supply chain for memory components, specifically NAND and DRAM, is currently experiencing severe pricing inflation.
Prices are going up.
Fast. The underlying cost for vendors like Lenovo, HP, or Dell to manufacture a computing device is escalating rapidly. Best Buy's procurement team modeled this trajectory and realized that the wholesale cost of laptops would spike significantly in the back half of the fiscal year.
So what did they do?
To mitigate this, they deliberately pulled forward hundreds of millions of dollars in computing inventory, purchasing the units now to lock in the lower historical cost basis.
We literally bought it early.
Exactly. They intentionally swelled their Q1 inventory to avoid paying the inflated Q3 vendor prices.
Oh, wow, that's incredibly smart. But let's test that assumption. What if consumer demand craters in the fall?
That's the risk.
Best Buy is suddenly holding an 8% heavier bag of aging laptops. They are taking an immense balance sheet risk to protect those margins.
The risk is real, but the strategic upside is a massive competitive moat.
How so?
By locking in a lower cost basis on those computing units, Best Buy effectively insulates itself from the impending inflation.
Right.
When their competitors are forced to dramatically raise retail prices in Q3 to offset the surging memory costs, Best Buy can hold their retail pricing steady.
Cool.
They will be able to offer superior hardware at a lower price point than the competition, capturing massive market share from budget-conscious consumers, all without compressing their own profit margin.
It is brilliant, aggressive supply chain chess.
It really is.
Because they explicitly noted that their core demographic operates on strict budgets. If a student has $500 allocated for a laptop, they aren't going to magically find $600 just because DRAM components got more expensive.
Right, they just can't do it.
They will just settle for a degraded, lower-tier machine. But Best Buy's inventory pull forward guarantees they can still offer a premium machine at that critical $500 threshold.
And managing these complex, multidimensional strategies, from global semiconductor hedging to monetizing first-party ad data, it requires a very specific type of leadership.
Which brings us to the massive executive pivot announced on the call.
Yes.
CEO Corey Berry is stepping down, transitioning the role to Jason Bonfig on November 1st.
This is a huge shift.
Corey Berry's tenure was defined by stabilization. She navigated the company through the acute crisis of the pandemic, the subsequent supply chain paralysis, and massive inflationary pressures.
She kept the ship afloat.
Exactly. But Jason Bonfig's elevation signals a dramatic shift from defense to offense. He isn't an external hire. He is a 27-year veteran of the company who came up through the merchandising ranks.
He knows the nuts and bolts.
He has intimately managed e-commerce, marketing, supply chain logistics, and most importantly, Best Buy ads.
Right. And when a new CEO lays out their strategic pillars on their inaugural earnings call, you parse every single word. Bonfig's explicitly stated first priority is to advance Best Buy as a retail, media, advertising, and technology company. He is actively commanding Wall Street to change the lens through which they view this business.
And his third priority regarding their real estate portfolio is where the physical execution of this vision gets fascinating.
The smaller stores.
Yeah, they are rapidly optimizing their store formats based on local density. They are rolling out purpose-built, small format stores, roughly 12 to 15,000 square feet in hyperdense urban environments, alongside medium 20,000 square foot formats.
But it isn't just about shrinking the footprint to save on rent.
No. He noted a highly specific metric. When they open a new localized store, they see a material, sustained lift in purely digital online engagement from that specific zip code within 6 months.
This completely upends the traditional view of brick and mortar as a liability.
Right.
The physical store is functioning as a highly localized customer acquisition tool, like a physical billboard that builds trust and drives digital conversion.
Yeah, it's marketing.
But more crucially, these localized formats are the backbone of their fulfillment logistics.
The logistics metrics are staggering. 65% of their total online purchases are now delivered or made available for pickup within one single day.
That's Amazon-level speed.
And 45% of all online orders are executed through BuboPI's Buy Online, Pickup in Store.
Almost half.
Almost half of their digital customers are opting to drive to a physical location to retrieve their items.
And the unit economics of a BuPI transaction are the holy grail of omnichannel retail.
Tell me why.
Well, when a customer picks up an item in store, Best Buy eliminates the incredibly expensive last-mile shipping costs.
Which kills margins.
Kills them. They also eliminate the risk of porch piracy, which is a growing issue for electronics.
Yep.
But most importantly, they force a digital customer into a physical environment, immediately triggering the opportunity for high-margin accessory cross-selling.
Right. You come in for the laptop you bought online, but you walk past the mice and the carrying cases.
Exactly. It is an incredibly efficient fulfillment loop.
And they are applying the same optimization logic to their legacy, massive format stores too.
Oh, the Meta partnership.
Yes, they are taking roughly 70 of their largest locations and actively consolidating the empty, underutilized floor space. In 50 of those stores, they're executing a strategic partnership with Meta to build dedicated 900 square foot Meta Labs. These are specialized, highly staffed environments designed exclusively to showcase augmented reality, AI glasses, and virtual reality ecosystems.
The Meta Labs initiative is brilliant because it solves a fundamental problem for hardware innovators.
Which is?
Meta cannot sell a $500 spatial computing headset through a static web page.
No, you have to try it on.
The consumer needs to experience the field of view, the latency, the tactile comfort of the device.
Right.
By leasing that floor space to Meta, Best Buy monetizes previously dead square footage while simultaneously branding itself as the exclusive physical gateway for next-generation technology.
They were literally monetizing every square inch. In other large stores, they are utilizing the consolidated space to install Yardbird premium outdoor furniture displays or dedicated outlet assortments.
Just filling the space with whatever works.
Yeah. And the connective tissue binding this massive omnichannel experience together is their newly revamped membership strategy. Best Buy Plus in total now boast over 8 million paid members.
That's a huge subscriber base.
And the economics of a paid membership program are designed to create extreme customer lock-in. Starting next week, they are fundamentally shifting the reward structure.
Right, the new percentages.
Yeah, they're allocating 1% back in rewards on every purchase for paid members and an aggressive 6% back if the transaction utilizes the Best Buy co-branded credit card.
6% is massive.
Let's look at the margin implications of that 6%. Offering 6% back on a $2,000 OLED TV is a massive hit to their front-end profitability. How do they absorb that without crushing their gross margins?
Well, they absorb it through the velocity and stickiness of the ecosystem.
How so?
The Best Buy credit card carries its own lucrative financial kickbacks from the issuing bank.
Right, standard credit card revenue.
But more importantly, the lifetime value of a customer embedded in that 6% return loop skyrockets. If a consumer knows they are earning a 6% yield on their electronics purchases, they are mathematically disincentivized from ever cross-shopping at Amazon or Walmart for tech hardware again.
They're locked in.
Exactly.
Yeah.
Furthermore, a significant portion of those rewards liability is likely subsidized by the vendors themselves through the Best Buy ads network.
It's an impenetrable walled garden.
It really is.
Which brings us to the forward-looking outlook. We've dissected the mechanics of Q1. But how is leadership pricing all of these structural changes and supply chain risks into the rest of the year?
Let's look at the guidance.
Let's scrutinize the management guidance. For the second quarter, management is projecting comparable sales growth of approximately 1%, with the operating income rate remaining flat at 3.9%.
Which seems a bit conservative.
For the full fiscal year 2027, they resolutely maintain their original baseline guidance. They are forecasting total revenue to land between $41.2 billion and $42.1 billion. Full-year comparable sales are projected in a tight window between -1% and +1%, and EPS is modeled between $6.30 and $6.60.
Right.
They also leaned heavily into their capital allocation strategy. emphasizing a $300 million share repurchase program for the year.
Investors love that.
And they made a distinct point of highlighting their status as a premium dividend payer, having aggressively raised their quarterly dividend for 13 consecutive years. They returned $202 million in direct shareholder value in Q1 alone.
And, the consistency of that capital return is a powerful signal to institutional investors.
How so?
It demonstrates that despite the aggressive capital expenditures required to build out Meta Labs, overhaul their fulfillment logistics, and execute massive inventory pull forwards, the underlying core business generates an absolute torrent of free cash flow.
Yeah, they have cash to spare. But I need to challenge the Q2 guidance logic, because I see a massive contradiction in the transcript.
Okay, what did you see?
Management explicitly stated that their real-time sales data for May was incredibly robust, tracking at high single digits growth.
Right, May was strong.
So if May is already locking in high single digits, projecting a mere 1% growth for the entire second quarter seems wildly pessimistic. Are they modeling a complete macroeconomic collapse in June and July?
The guidance feels contradictory until you apply the critical retail metric of the lapping effect.
The lapping effect, explain that.
You have to isolate exactly what Best Buy's revenue baseline was during the corresponding weeks of last year.
Right, the year-over-year comparison is everything.
Let's look at the tape from last June. Best Buy essentially caught lightning in a bottle.
They did.
Yeah, they launched a highly anticipated, massive Switch hardware and software bundle that generated an anomalous, almost instantaneous $200 million revenue spike. Furthermore, they experienced an unseasonably early surge in back-to-school computing purchases and a massive wave of Windows 10 enterprise upgrades hitting simultaneously in July.
So it was just a freakishly good quarter last year.
That is the definition of an incredibly tough comp. The back half of their Q2 last year was structurally inflated by unique, non-recurring catalysts.
I see.
So when June and July of this current fiscal year arrive, they aren't just trying to grow. They are trying to grow over a $200 million anomaly.
It sets the baseline bar impossibly high.
Exactly.
And if we look closely at the May data, management actually conceded that the high single digits momentum was partially artificially boosted by a delayed wave of IRS tax refunds spilling over from April.
Precisely. You have a marginally inflated May colliding with mathematically brutal year-over-year comparisons in June and July.
Right.
When the internal analysts blend those contrasting trajectories, guiding for a consolidated 1% comparable growth rate is actually a highly pragmatic, perhaps slightly defensive calculation.
Under promise, over deliver.
Exactly. It manages Wall Street's expectations while leaving room for an earnings beat if the RGB TV launch over-indexes.
The lapping effect is a perfect example of why data cannot be analyzed in a vacuum. You always have to determine the baseline context.
100%.
We have pulled apart the headline margins, examined the enterprise computing stickiness, dissected the supply chain hedging, and scrutinized the conservative guidance.
We've covered a lot.
It is time to distill these mechanics into an actionable stance. So what does this all mean? For an investor analyzing this space, what is the definitive signal?
The signal is that Best Buy is currently executing one of the most sophisticated, deceptive corporate dual identities in the public markets.
Deceptive.
Yeah. Outwardly, they present as a stabilized, slightly mature, big box retailer navigating a tricky macro environment.
Right, just a place selling TVs.
Internally, they are rapidly scaling a high-margin technology, media, and logistics platform that utilizes physical floor space as a loss leader for data acquisition.
Based on the structural mechanics we've uncovered today, we are taking a strongly bullish stance on BBY.
Without a doubt.
This earnings call is a definitive green light for those holding or considering the equity. Look at the defensive and offensive levers they're pulling simultaneously.
Right.
Defensively, they are proactively shielding their margins from semiconductor inflation through aggressive, calculated inventory pull forwards.
Very smart move.
And offensively, they are positioned as the exclusive national gateway for the massive RGB display upgrade cycle, while their B2B enterprise division provides a durable, recurring revenue floor.
And more importantly, the quality of their revenue is dramatically improving.
Because of the ad network.
The exponential growth of Best Buy ads in the domestic marketplace means they are extracting high-margin capital directly from the marketing budgets of their own vendors.
Yep.
Bonfig's leadership strategy recognizes that their most valuable asset is not the hardware they sell, but the first-party purchase data generated by the people buying it.
And as an investor, The capital allocation strategy makes waiting for this transformation incredibly lucrative.
You get paid to wait.
Literally.
Okay.
A 13-year streak of escalating dividends, coupled with a massive share repurchase program, means you are generating a premium yield while management executes the physical restructuring of the real estate footprint.
They're ruthlessly optimizing the variables they can control.
Yeah.
But if we extrapolate this transformation out over the next 24 to 36 months, it raises a profound question regarding how the broader market assigns value to this company.
I love looking at the structural mispricings. What is the market failing to price in here?
Well, we established that nearly half of Best Buy's massive digital sales volume relies on fiscal in-store pickup, essentially converting their legacy retail boxes into hyper-localized distribution and fulfillment hubs. Simultaneously, they are reformatting their largest locations into brand-subsidized showrooms like the Meta Labs and monetizing their digital traffic through a highly profitable retail media network.
They are building an ad tech platform on top of a logistics network.
Exactly. But right now, Wall Street still assigns Best Buy a price-to-earnings multiple, strictly aligned with traditional, low-margin, brick-and-mortar hardware retailers.
Right, they're pricing it like a retailer.
If Bonfig successfully scales Best Buy ads to the point where media and marketplace commissions constitute the lion's share of their operating profit, the fundamental identity of the stock changes.
Yeah, it becomes a tech stock.
If institutional investors are eventually forced to re-rate and value Best Buy, not as a store that sells refrigerators, but as a high-marking, tech-enabled advertising network with a localized logistics moat.
Then what does that multiple expansion look like?
That's the question you have to ask yourself.
A multiple expansion from a traditional retail valuation to an ad tech valuation implies a massive asymmetric upside that the market is currently ignoring.
Exactly.
That is the exact kind of systemic, mechanism-driven insight we aim to uncover here.
It's all in the data.
A massive thank you to everyone for joining us on this incredibly deep Talk Checkers deep dive into Best Buy. When the underlying unit economics and strategic pivots are this complex, you have to ignore the noise and follow the data. Keep questioning the consensus, keep looking past the headline metrics, and we will catch you on the next deep dive.